everyone, thank you for joining us. This article focuses on a crucial aspect of Nigeria's economic landscape, which is the floating exchange rate system, its potential tax implications, as well as the management strategies that businesses can adopt to navigate these challenging waters. Over time, the Central Bank of Nigeria has adopted various exchange rate systems, including controlled rate, floating, and the managed floats, in an effort to stabilize the market. While Nigeria's economy has shown growth, concerns about rising inflation rates persist, which have prompted calls for monetary reforms, all to bolster foreign reserves and provide a buffer against shocks. In June 2023, the Central Bank of Nigeria announced significant changes to the country's foreign exchange market operations, which involved consolidating exchange rates into the investors and exporters window under a floating rate system. With this, the exchange rate is determined by forces of demand and supply. A major tax implication of the floating rate system borders around treatment of foreign exchange gains and losses, which by extension can impact taxable profits. That's when we consider the revenue implications, whether the gains or the losses are realized or unrealized. This brings us on to the crystallization of deferred tax assets and liabilities, which occur due to the difference between accounting and taxable profits. Floating exchange rates lead to temporary differences that can result in future tax recovery or payments when these differences become realized. Also, businesses engaged in imports and exports may confront significant vulnerability to fluctuations typical of the floating exchange rate system. The volatility of currencies can distort costs, revenues, profitability, and even contribute to inflation. Consequently, the cost of importing and procuring foreign-denominated goods and services will rise substantially, which may in turn lead to increased government revenue from import duties, value-added tax, and related custom charges. Nevertheless, the impact of the floating exchange rates on businesses can be mitigated through the use of financial instruments like forward contracts or options to hedge against foreign exchange rates typical of currency fluctuations. We also encourage considerations in advanced pricing agreements to prevent transfer pricing disputes. The need for companies to also collaborate with experts in international tax regulations and currency risk management is highly recommended as well. Conclusively, as credible exchange rate management becomes key for market transparency and foreign investment stimulation in Nigeria, the interaction between floating exchange rates and tax implications require comprehensive strategies. Adequate documentation, compliance adherence, and strategic planning are vital to navigate the complexities of foreign exchange gains, losses, transfer pricing translations, and their overall impact on taxable income. As the Nigerian economy continues to evolve within the global market, businesses that address the challenges of fluctuating exchange rates are strategically positioned to thrive amidst economic expansion and stability policies. Meanwhile, it is expedient that the government does not place excessive burdens on taxpayers during these challenging times. Instead, there should be a focus on providing tax benefits and incentives to stimulate business activities and attract investment to support economic growth and development. To read more on our articles, please visit our website and subscribe using the button below. Thank you.